We did have, though, the Russell 2000 posting its 9th day of gains in 10, S&P and NASDAQ coming off record highs. And Steph, you have the president talking about and threatening more tariffs, and UBS really hits the nail on the head today. The remarkable resilience of the U.S. equity market persists. And that's what the story is, and that's what the story remains. The question is, can it continue to do that? It can.
Yes.
Tell our viewers why you think so.
Yes. The market is resilient despite the noise with regards to tariffs, with regards to the geopolitics, with regards to the Fed and the unknown there. And at the same time, we're growing at 2.5%. And 2.5% GDP growth equates to something like mid-single-digit total revenue growth with a little margin expansion, which is what I expect. I think you're going to see 10% earnings growth. The market expects 5%. I think that's going to be the catalyst going forward. And I want to be overweight industrials, which I am, financials, which I am, and now in discretionary, we're going to talk about housing in a little bit, but I want to be overweight housing.
Okay, so Josh, Michael Hartnett at B of A he always has a good way of putting things. I'll say that. And today he says the title of his note is No Pain, No Pain. He says the options volatility index, a.k.a. the VIX of bonds, plus the VIX itself equals the best taco index. Lowest bond and stock volatility since February 19th equals no policy fear, equals stocks and crypto liking the Trump policy flip from detox to gorge, see ARK Innovation versus Berkshire Hathaway, going all in until the 30-year bond yield jailbreak levels, as he calls them. In the UK, it's 5.6. In the US, it's 5.1%. Japan, 3.2. Until all those levels are breached, you do have a jailbreak, and we can throw the 30-year up to just give our viewers an idea of where it is today relative to the Hartnett level. And I'll toss it to you to tell me what you think about what he has to say.
Right. So the premise is if bond yields, real bond yields, far out in the curve break out above those levels, it signifies the big conservative money is truly concerned about the effect on the U.S. economy, which would imply this is where the market will actually start to believe these tariff headlines, and the taco thing will come to an end. I think that's what he's saying. I think that's as good as any other possible indicator that we might have. I had a conversation with Ryan Dietrich from Carson Wealth yesterday about this very subject. What are the things that you look at when the stock market volatility spikes to calm yourself down and to remind yourself that this is all fake and it's mostly for show? Credit spreads didn't blow out in April, Ryan reminds us. That was a really good tell that nobody was taking this that seriously away from the stock market. Another thing that I looked at, foreign stocks. I don't even think most people realize what foreign stocks were doing while these ridiculous tariff numbers were first being floated. They were rallying. The international investor was laughing at the notion that we were going to have 150% tariffs on China. So there are a lot of things you could look at. I don't hate this jailbreak idea, looking at longer dated yields. I think the most important thing that you have to ask yourself in the year 2025, if you want to be invested in the stock market, which is going to have a longer lasting, deeper, more profound impact on the way we live our lives in the year 2030? Will it be the AI revolution currently underway, or will it be the things that the president puts on Truth Social in in the year 2025? Like which of those things will be the driving force behind profit margins, earnings, employment, et cetera? So I think most people in the stock market at this point have settled on the idea that AI will be much longer lasting, much more profound than whatever tariff rate Canada has to pay us for the next couple of months. And that's where I stand at this point as well.
Okay, Jenny, I mean, the market's resilient. We know that. And we know that buyers are pretty eager to grab the winners. The flow show at Bank of America, tech and financials buying. Tech, the largest inflow since Liberation Day. Financials, the largest inflow in 6 months. That's interesting in and of itself. So it gives you an idea of what people continue to buy.
Right, so that's what people are buying, but there is a broadening out, and we can't ignore that. It's really interesting. If you look at the S&P equal weighted index, it's up 7%. That's just in line with the S&P itself. I think the way we're thinking of it at Gilman Hill, and I'll just give you exactly what happened yesterday. We have a new client account, and they said, look, I want to work with you. Choose whichever one of your strategies you think over the next year is going to make me the most money. So we could choose from the dividend income, international income, or the disciplined growth. And if you'd asked us this same question several months ago, it would have been probably the international strategy, maybe some of the dividend stocks because we thought they were really undervalued. Today, we actually said to this client, okay, we're going to do 100% in our disciplined growth strategy. But that for us is not the S&P 500. So it's stocks like Schwab, Freeport-McMoran, TripAdvisor, GXO Logistics, United Rentals, Cisco. And so when I think about the fact that the equal weighted composite is actually up as much as it is, I think there is a lot of money that's also going in to, to things other than the Mag 7.
And you think that's going to continue?
I think it should. And I think it should because when we look at relative growth rates and we look at the Mag 7 and how it outperformed the rest of the S&P, and from an earnings growth perspective, it outgrew the rest of the S&P by 35% the last 2 years. That growth differential is narrowing. I don't know how much it's going to narrow by. JP Morgan put out some great estimates in their guide to the markets where like this year it looks like I think it's a 9% differential. Next year it should be a 2%. Probably it's going to be wider than that, but the differential is narrowing. So you have 493 companies that people are saying, hey, you know what? Earnings are pretty good here, and valuations are also compelling. They're not more compelling, they're just also compelling. And so when we look out with respect to opportunities for the growth portfolio, there's lots of non-Mag 7 that are simply compelling.
I'm with Jenny on this. I think there is a lot of room to be a stock picker here. And a lot of people may be looking at the markets and they're saying, oh, it's 21, 22 times earnings. How could I possibly get in? You got to pick your spots. You can pick sectors, and don't everybody jump on me at once, but the healthcare sector has a lot of attractively priced stocks in it.
Well, the whole point, when you look at, to your point, I'll give it back to you in a second, but that's why Jenny's talking about those stocks.
Yes, that's
because the multiple is completely different of the equal weight and stocks like that, rather than looking at the S&P 500, for which is so top-heavy of tech and some financial stocks and some big industrial stocks, too. There's all these others that are waving and saying, hey, maybe now is like the right time for a big catch-up trade.
Well, yes. And maybe, Scott, it's maybe even more than a catch-up trade. Maybe it's fundamentally based. Again, I was talking about healthcare stocks, a lot of pharmaceutical stocks that trade at mid-teen multiples with 3 to 4% dividend yields. I can pick off stocks. I can look at something like a Lockheed Martin in industrials, which hasn't performed with the rest of the sector. I mean, there are a lot of places you can go. It's not, and what I'm trying to say, and I think, Jenny, you were trying to say this, it's not a market where you have to hold your nose to buy stocks.
Do you have to hold you're insinuating you have to hold your nose to buy the mega caps and the larger cap stocks?
Some of them.
If anything, you haven't had to.
Well, from a valuation point of view, which is where a lot of us on the desk, and especially me, reside, if I were to say, look at a Microsoft, I would have to hold my nose to buy that here at this multiple. I wouldn't, however, and again, this is to the point of it's a stock picker's market. If I looked at Alphabet, I wouldn't have to hold my nose. NVIDIA, I wouldn't have to hold my nose.
But there are a lot of stocks in the area you guys are talking about where people have to cover their eyes.
Like Walmart.
Not because of the valuation, but because it's harder. The risks are seemingly higher in those kinds of stocks relative to the NVIDIAs and to the JP Morgans and to the Caterpillars.
Okay, Jenny, give me just one shot at this. Okay, I see your point. Take a look at Delta Airlines yesterday. It is hard to own something like Delta Airlines until you get that earnings report that says the fundamentals are intact. And that's where Stephanie, Jenny, and I reside, and Josh, too, is looking at the fundamentals. And a stock that hasn't performed well but has the fundamentals intact, you're just waiting for the market to recognize it.
But on the other side of the Delta trade, like I think you need to hold your nose to own a Walmart, which trades at 30 times earnings. Right, has decent growth ahead, but that is a really rich multiple, and I don't think that multiple is justified. I think there's a tier of stocks kind of beneath the Mag 7 that have been floated up with the broader market. So there are stocks out there, but it really emphasizes Jim's point: if you can be a stock picker, there are compelling combinations of valuation and earnings out there, and it's not. I don't think the spotlight will shine entirely on the Mag 7.